Okay, so over the last couple weeks, we've been focusing on banking and T accounts and how banks function and how banks create money or change the money supply based on their ability to loan out money. The point of that was not solely to understand banks, but understanding banks is ultimately going to help us understand monetary policy, which is what this chart and this graph are about. The Federal Reserve, or the central bank of most of major economies, controls a bunch of different tools that allow it to change the banking system, and in changing the banking system, allow it to change the money supply and therefore change interest rates on our money market. So we're going to run through what each of these actions is, how it affects banking, and therefore how it affects the money supply and interest rates. The first and one of the most powerful tools that a central bank has is that in most economies, central banks control the reserve ratio. This, of course, is the amount of money that a bank has to keep on hand. So increasing the reserve ratio means that banks have to decrease the amount of lending that they do. They can't loan out money if they are forced to reserve it. This also means that we are going to decrease the money multiplier. The money multiplier works because banks are able to loan money, which turns into a new deposit in a new bank, which turns into a new loan. The higher the reserve ratio goes, the fewer loans are made, and the smaller our money multiplier becomes. So increasing the reserve ratio will ultimately decrease the money supply because it decreases banks' lending ability. The opposite is true of decreasing the reserve ratio. If the Federal Reserve decreases the reserve ratio, then the amount of lending that can happen in a given bank increases. They can hold less of their money and turn more of that money into new money through a loan. That increases the money multiplier, and by increasing the money multiplier, we increase the money supply. The discount rate is the trickiest of these policies because it doesn't directly change the money supply, but rather we frequently call the discount rate a signal rate to banks. Think traffic signal. It either gives banks a green light or a red light based on their interaction with the Fed. So the discount rate, by increasing the discount rate, the Fed is telling banks to be careful. And what we mean by this is that if a bank winds up needing to come to the Fed and come to the discount window that the Fed offers, they are going to pay a higher rate or a higher price for having to come to the Fed for not meeting their reserve ratio. So the Fed is saying, be careful, do not lend out too much money. It is kind of hinting to banks, you should decrease your lending so that you are prepared for the possibility of not meeting your reserve requirement. This, of course, scares banks, so banks decrease their lending, and that decreases the money supply. Decreasing the discount rate works the opposite way. It ultimately is kind of a green light. It is telling banks, loan a lot. Send that money out. If you get into trouble, we're going to bail you out. We have a nice low discount rate when you come to the discount window, and we are willing to help you when you stretch yourself too thin. If banks increase lending, they increase the money supply. Our final monetary policy is buying or selling bonds, also known as open market operations, because the Fed actually conducts these out in the open market, buying and selling from individuals, corporations, and banks all the time. When the Fed buys bonds, the phrase that I like to use here is the Fed gets the bond from the individual or the corporation, and in return, people get money. In this case, the Fed is legitimately just pumping money into the economy. What do people do with their money? This is an increase in the amount of money in the banking system. And by increasing the amount of money in the banking system, we are increasing the money supply. Selling bonds works the opposite way. The Fed gets money, pulls money out of the banking system, and people or banks get bonds. If people get bonds and the Fed is getting money, then the Fed is legitimately deleting money from the banking system. It is pulling money out of banks, out of our bank accounts when we give them our money, and therefore it is decreasing the money supply directly. They're not only decreasing the money supply directly in this case by pulling the money out of our accounts, but they are also then decreasing the multiplier as we've seen through, or decreasing a greater amount because that amount is multiplied with the multiplier through the entire process we see in our T accounts. And what we can lastly add here is what this does to interest rates. So if we come over onto our graph, just as a handy sheet here, what can decrease our money supply? Well, we now see that increasing the reserve ratio, increasing the discount rate, and selling bonds are all options that decrease the money supply. And what happens when we decrease the money supply? When we decrease the money supply, we see an increase in the interest rate in our money market. So in each of these, we can say decreasing the money supply will increase interest rates in the economy. Remember, the Fed is not really targeting money supply. They're targeting the money supply in order to change interest rates in the economy, which is going to affect behavior on our demand curve later. On the other side of this, if they decrease the reserve ratio, decrease the discount rate, or buy bonds, they're going to increase the money supply. And increasing the money supply is going to decrease our real interest rate, or our nominal interest rate in this case, a lower interest rate through each of these actions. So you should be able to see what these actions do, how they change the banking system, how they change the money supply, and using our money market, how they change interest rates.